In 2011, a group of political researchers stumbled onto something that I still find uh, absolutely mind-blowing.
Oh, yeah, that study is wild.
Right. They realized they could predict a massive chunk of a person's societal worldview, like down to how they actually vote at the ballot box, just by figuring out how that person answers one incredibly simple question.
And it's a question we all ask ourselves, constantly.
Exactly. The question is, when you fail, whose fault is it?
Yeah.
It turns out your psychological wiring regarding blame and control doesn't just dictate your personal life. It scales up to shape, well, entire nations.
It's foundational.
It really is. And I want to talk directly to you for a second, the person listening to this. You're here because you are a learner. You actively seek out information to cut through the absolute avalanche of noise we deal with every single day.
Which is exhausting, by the way.
Oh, completely exhausting.
Yeah.
But let me ask you, despite all the books, all the podcasts, all the research, have you ever felt like you are still just reacting?
Like you're always one step behind.
Yes. Reacting to the market, reacting to sudden fires in your business, reacting to the endless flood of notifications. Have you ever felt like a retail hobbyist standing in a pitch-black room, just tossing darts at a board and hoping one of them hits the bullseye by pure accidental chance?
That underlying anxiety is so common. It's practically the default state for most professionals today.
Right.
It's the creeping suspicion that your positive outcomes are entirely accidental, that you're just floating on a current rather than actually steering the ship.
And that feeling of powerlessness is exactly what we are dismantling today. The mission of this deep dive is to completely unpack the architecture of intentionality.
I love that phrase, architecture of intentionality.
Yeah, we're going to explore the transition from being that reactive retail hobbyist tossing darts in the dark to becoming a highly disciplined institutional practitioner.
And we have a really eclectic mix of sources to get us there today.
We really do. The stack of sources for this deep dive is phenomenal. We're pulling from the extreme ownership principles of Navy SEALs Jocko Willink and Leif Babin. We've got clinical psychology from the 50s and 70s on the locus of control by Julian B. Rotter and Bernard Wiener.
Heavy hitters.
For sure. Then we're getting into the structural engineering side of things with system dynamics from Haraldson and Sverdrup. We'll examine the contrarian company of one, business philosophy, from Paul Jarvis and Joachim Eekhout.
Which completely flips the standard startup narrative on its head.
Oh, absolutely. And then we're digging into institutional finance frameworks from Dex Capitals and CFA Institute. And finally, looking at tactical data filtering in the crypto space with GMGN.ai and Scriptbox.
What's fascinating here is that while these sources span, military doctrine, clinical psychology, systems engineering, decentralized finance, the through line is incredibly elegant.
Yeah, how would you define that through line?
Collectively, they prove one undeniable law. Professional, institutional grade results are never an accident.
Right.
They are the non-accidental byproduct of a highly calculated, rigorously defended process. And today, we're going to give you the exact blueprint to build that process.
I am so ready for this.
Yeah.
But building that process, it has to start from the inside out.
It always does.
Before we get into structural mapping or writing corporate policy, we have to talk about the psychology of accountability. We have to fundamentally rewire how you perceive success and failure.
So we're starting with extreme ownership.
Exactly. Let's unpack it. This comes from Jocko Willink and Leif Babin, two former U.S. Navy SEAL officers. And the core tenet is absolute, unequivocal responsibility. But it's not just about owning your own mistakes, right?
No, it goes way beyond that.
Yep.
It means leading both down the chain of command, taking the hit for your team's failures, and leading up the chain of command.
And I want to pause on that because this is where my brain always short-circuits a bit.
It's a tough concept to swallow.
It really is. Leading up the chain of command means if your boss makes a terrible call, you blame yourself first for not communicating the reality on the ground clearly enough.
Right.
But let's apply this to business. Let's say a massive global supply chain crisis bankrupts my primary supplier. How on earth is that my fault? Taking ownership for a macroeconomic disaster feels almost delusional.
Well, it feels delusional if you view ownership as a synonym for causation.
Okay, causation.
Yeah, you didn't cause the macroeconomic disaster, you didn't cause the supplier to go bankrupt. But extreme ownership isn't about claiming you caused the storm. It's about owning the fact that you built a ship that couldn't handle it.
Oh, wow. That's a great way to put it.
If your supplier goes under, the extreme ownership mindset says, I failed to build redundancy into my supply chain. I failed to monitor their financial health. I failed to stress test my own business model against single point of failure risks.
Ah, okay. So it's not about taking the blame for the event itself. It's about taking the blame for your vulnerability to the event.
Precisely. Because the moment you say, it was the supplier's fault, what
You're
happened?
off the hook.
You surrender your agency. You've declared that your business survival is in the hands of external entities. The SEALs found that when a leader swallows their ego and says, this failure is on me because my contingency planning was weak, it immediately shifts the brain
Shifts it how?
from a state of victimhood into a state of active problem solving. It eliminates that toxic culture of finger pointing, which is just a massive drain on operational energy.
And this brings us right back to that 1970s and 1950s psychology I mentioned in the intro. Because Willink and Babin popularized this in the context of modern warfare. But Julian B. Rotter gave this mindset a clinical name back in 1954.
The locus of control.
Yes. And locus just means location. Where's the location of control in your life? Rotter said we all operate on a spectrum between an internal locus and an external locus.
Yeah. So if you have a strong internal locus of control, you fundamentally believe that you drive the vehicle. You attribute outcomes to your own actions, your effort, your ability.
Give me an example.
So if you launch a sauce product and it completely flatlines, an internal says, my market research was flawed, or my user interface was too complex. They believe their inputs directly dictate the outputs.
Whereas an individual with an external locus of control believes the vehicle is driving them.
Right, they're just passengers.
They think outcomes are dictated by chance, the algorithm, the economy, or powerful gatekeepers. When that same sauce product flatlines, they say, the big tech monopolies squeezed us out, or customers just don't understand the genius of our product, or we just launched on a bad week.
Which is why Bernard Wiener's addition to this theory in the 1970s attribution theory is so vital here.
Right, because he added some nuance.
Exactly. Wiener argued that just saying internal versus external isn't enough resolution. We also evaluate whether those causes are stable or unstable.
Okay, stable meaning it doesn't change, unstable meaning it fluctuates.
Right. And this creates a 4-quadrant matrix that every professional needs to understand to diagnose their own failures.
Let's walk through this matrix. Let's stick with the example of a blown trading account or a failed business launch. What is the first quadrant?
The first quadrant is internal and stable. This is your inherent ability or the baseline systems you have built. It comes from within you and it doesn't change rapidly.
So if you blow up your trading account and you attribute it here,
You are saying, I fundamentally do not understand risk management mathematics yet. I lack the baseline ability.
brutally honest. Okay, the second quadrant would be internal but unstable.
That is effort or vigilance. It's internal, but it fluctuates day to day. If you attribute failure here, you're saying, I have the ability to manage risk, but yesterday I was tired, I got lazy, and I didn't stick to my own rules.
I've definitely been there. Okay, so that covers the internal side, ability and effort. What about the external side?
The third quadrant is external and stable. This is task difficulty or structural market regimes. It is outside of your control, and it represents a fixed, enduring reality.
So attributing failure there sounds like what?
Saying, the Federal Reserve completely altered the interest rate environment, making tech startups structurally harder to fund right now.
Okay. And finally, the fourth quadrant, external and unstable.
That is luck or chance or a true black swan event. A global pandemic shut down international shipping the exact week my physical product was supposed to hit the shelves.
This matrix is brilliant because it gives us the tool to conduct what we'll call an error autopsy.
I like that. Error autopsy.
Yeah, when you fail, you have a dead outcome on the table. The project is dead. The question is, how are you cutting it open to find the cause of death? Are you diagnosing a system error or a user error?
That's a great distinction.
Right, because the system error is quadrant 3 or 4, a massive regime shift or an unpredictable macro event. But a user error is quadrant 1 or 2, a failure of your own discipline, your lack of effort, or a flaw in your ability. And the danger of the retail hobbyist is that they autopsy every single failure as a system error.
They absolutely do. Everything is the market's fault. And the psychological research cited in our sources explicitly notes the toll this takes.
The mental toll.
Yes. People with a chronic external locus of control experience significantly higher levels of baseline stress and are highly prone to clinical depression.
That makes total sense. If you genuinely believe that shadowy institutional forces or random luck are entirely in control of your financial destiny, you are constantly living in a state of existential threat.
You're helpless.
You feel owed a moral debt by the universe, and you are trapped in a state of permanent victimhood. You have zero agency.
And if we connect this to the bigger picture, this brings us to that fascinating sociological data you mentioned in the intro regarding political ideology.
Yes, and I want to pause here. I want to be 100% crystal clear with you, the listener, right now.
Very important point to make here.
We are not taking sides. We do not endorse any political viewpoint, party, or ideology. We are strictly, impartially reporting the peer-reviewed sociological findings from the source text. Specifically, studies from the 1972 U.S. presidential election, which were later corroborated by Kay Sweetzer's research in 2011 and 2014.
Exactly. The goal here is just to show how deeply this psychological wiring penetrates human behavior.
Right. It scales up. So what did the data actually say?
It's a profound demonstration of scale. The researchers found a statistically significant correlation between a person's locus of control and their political registration.
Okay.
Individuals demonstrating a strongly internal locus of control, those who autopsy the world through the lens of individual effort and inherent ability, were substantially more likely to register as Republicans.
And conversely, individuals with a strongly external locus of control, those who view the world through the lens of systemic factors, historical context, and powerful outside forces shaping outcomes, were substantially more likely to register as Democrats.
Again, strictly reporting the data.
Just the data. But it shows that whether you view society as an arena where individual grit overcomes all obstacles or complex web where systemic inequalities must be managed from the top down, it all stems from how your brain assigns causality.
It dictates the lens through which you view reality. But I want to bring this back down to the individual practitioner, specifically regarding how this locus affects risk tolerance.
Oh, yeah. This is super counterintuitive.
Because there is a very dangerous misconception that having an external locus of control means you are overly cautious or passive.
Right. I actually wanted to push back on that when I read it, because when I read Rotter's source material on gambling, it suggests the exact opposite. If I'm an external and I think the universe is pulling the strings anyway, why wouldn't I just take massive, reckless risks?
Exactly.
I might as well bet my entire net worth on a meme coin because it's all just a casino anyway, right?
That is exactly what happens. Externals don't avoid risk. They take wildly uncalculated risks. Because they believe outcomes are dictated by fate, they fall prey to the gambler's fallacy.
Like at the roulette table.
Yes, they will stand at the roulette table and put their life savings on black simply because red has come up 5 times in a row, so black is due.
Right. They think the wheel owes them a black.
Exactly. They operate under the deeply flawed assumption that an inanimate wheel possesses a memory and that fate owes them a balancing act.
They are essentially trying to mind-read the universe. They think their external locus allows them to sense the rhythm of luck.
Which is pure magical thinking. Internals, by contrast, treat risk as a mathematical equation.
So internals are safer.
The research shows internals take safe, moderate, highly calculated wagers. They don't bet on fate, they bet on probability. If they are at the roulette table, they aren't looking at the last 5 spins. They are calculating the exact 47.4% probability of hitting black on a 00 wheel.
And they size their bets accordingly.
Yes. They size their bet so that a loss doesn't bankrupt them. They control the variables, their bet size, their entry criteria, and they systematically hedge against the variables they can't.
So tying this directly back to you, the listener, if you want institutional results in your career or your portfolio, you have to brutally audit your own error autopsies. Are you blaming the algorithm a system error when you really should be blaming your lack of high-quality content a user error? Are you taking uncalculated risks hoping fate bails you out, or are you operating like a casino actuary? You have to move that locus inward.
But here's the critical pivot. A mindset is not a mechanism.
Say more about that.
Well, once you have internalized that locus of control, once you accept that you are responsible for the outcomes you hit a wall, willpower and accountability are not enough. You have to actually build a structural system to manage the things you now own.
And that takes us directly from the psychology of accountability into the architecture of intentionality. We are moving from mindset to structural mapping. And our sources from Haraldson and Sverdrup on system dynamics provide the exact engineering workflow to do this.
Haraldson and Sverdrup are researchers who study complex systems, how chemical plants operate, how ecological environments balance themselves, how massive corporate workflows function.
High-level stuff.
Very. Their methodology is all about taking a vague mental model, an idea in your head, and forcing it into a precise quantitative model.
Let's really dig into the how here, because it's easy to say build a system, but what does that actually mean? Haraldson and Sverdrup talk about categorizing variables into agents, stocks, and actions, and then visualizing them using causal loop diagrams or CLDs and stock and flow diagrams.
Right.
Can we do a thought experiment and actually build a causal loop diagram right now?
Absolutely. Let's imagine you are running a consulting business. Your mental model is simply, I want more revenue. To turn that into a causal loop diagram, we map the feedback loops. Let's start with a stock.
A stock, like a pile of something.
Yes, an accumulation. In this case, your stock is active clients.
Okay, my stock is active clients. What increases that stock?
The inflow is new client acquisition, which is driven by the action of marketing outreach. So more marketing outreach leads to more new client acquisition, which increases the stock of active clients. That is a reinforcing loop.
Simple enough. I market more, I get more clients. But what's the catch?
The catch is the balancing loop. As your stock of active clients goes up, your available time, which is another stock, goes down.
Oh, right. There's only 24 hours in a day.
Exactly. And when available time drops below a critical threshold, the quality of your fulfillment action decreases.
Ah, and when fulfillment quality decreases, client churn increases, which drains the stock of active clients. Plus, because my available time is near zero, my marketing outreach action drops to zero, killing the inflow.
Exactly. You just verbally mapped a causal loop diagram.
Yeah.
The retail hobbyist only sees the reinforcing loop. Market harder, get more clients. The institutional practitioner maps the entire system and realizes that without mapping the balancing loop, the drain on time and quality, they're engineering their own collapse.
And this brings up a concept that I think is the most vital bridge in this entire discussion. Let's call it the physical proxy.
Yes, this is crucial.
Haraldson and Sverdrup draw a massive, incredibly stark line between mental actions and physical actions. I think a lot of self-help literature blurs this line, telling you that visualizing success is half the battle. System dynamics says absolutely not.
It is a critical distinction. A mental state, a desire, an intention, a mindset of extreme ownership has zero impact on the external world. It only affects your own internal brain chemistry.
Right.
If you want to affect the real world or change a stock of resources, that mental state must precipitate a physical action. The physical action is the proxy that carries your intention into reality.
Let me use a gym analogy to explain this physical proxy idea because I think it makes it so clear.
Okay, lay it out.
So getting fit is essentially what we're talking about, right? You can sit on your couch all day and have the most intense, burning mental desire to get ripped. You can visualize the outcome. You can read all the bodybuilding books. You can have an extreme internal locus of control, believing you are in charge of your body.
But you're still on the couch.
Exactly. The universe, or in this case your muscles, do not care about your mental model. Your mental intention has zero mass. Professional results like actually building muscle are a non-accidental byproduct of a calculated process. The physical proxy is you actually picking up the heavy iron. You have to translate the mental desire into the physical action of doing a bicep curl. If you don't build the physical proxy, the actual scheduled bodily movement of lifting the weight, the muscle never grows.
That is the perfect way to look at it. You have to lay down the copper wire. Think of it like an electrical circuit. Your mental intention is the voltage sitting at the wall outlet. It has potential energy, but it's doing nothing. The physical proxy is the copper wire. You have to lay down the copper wire of a daily routine, a scheduled marketing block, an automated saving transfer. If you don't build the copper wire, the electricity has nowhere to go and the light bulb never turns on.
And mapping that copper wire is the essence of professional execution. You don't just set a revenue goal. You map the exact physical steps, identify the bottlenecks, and measure the delays in the system.
But let's apply this structural mapping to business scaling, because I want to bring in our source on The Company of One, which is Yochai summary of Paul Jarvis's book.
Yes, the company of one.
Because when we talk about building these causal loops and scaling a business, the traditional Silicon Valley narrative is that the only goal is hypergrowth. You build the system to secure venture capital funding, you scale up massively, you acquire 1 million users at a loss just to capture market share.
And the data reveals how incredibly toxic that model is for the vast majority of founders. The source cites a study by the Startup Genome Project on 3,200 high-growth companies. It found that 74% of them failed, and they failed specifically because they grew too fast. Premature scaling is the leading cause of death.
But hold on, let me play devil's advocate for a second. Let's say I launch a software tool and it goes viral. Suddenly I have 10,000 users overnight. If I don't take VC money, how do I pay for the AWS servers to keep the platform from crashing? Isn't scaling capital mandatory for survival if the market demands it?
This is exactly what the company of one philosophy pushes back against. You are assuming that you must service all 10,000 users immediately.
Because they're there.
Right. But a company of one would cap new registrations at 500 users, put the other 9,500 on a wait list, and ensure the product is flawlessly stable and profitable for those first 500. You dictate the pace of growth based on your system's constraints rather than letting external demand dictate your system.
Because hypergrowth creates what the source calls the hungry ghost.
Yes, the hungry ghost. It's the exponential complexity that comes with VC-funded scale. You take the money to buy the servers, but now you have investors demanding 10x returns, so you hire a massive sales team to get 100,000 users. Now you need a massive HR department to manage the sales team and a huge middle management layer.
And suddenly, you aren't focused on your core product anymore.
Exactly. You are entirely consumed by feeding the administrative overhead of the beast you just built.
It's like fanning the flames of a house fire with gasoline, hoping the sheer heat will eventually dry out the water damage. You're trying to solve infrastructure problems created by scale with more scale. It's a doom loop.
Which is corroborated by a second study cited in the text from the Kauffman Foundation and Inc. magazine. They looked at 5,000 highly successful businesses, defining success as surviving 8 years without massive layoffs or severe devaluation. Guess how many took VC money?
It's a crazy number.
86% of those successful, durable businesses never took a single dime of venture capital.
86%. That completely destroys the mythos of the startup world.
It really does. So how does a company of one actually operate?
First, clarify that a company of one doesn't literally mean a single freelancer working in a coffee shop. It's a structural philosophy that can apply to a team of 50. The philosophy demands what Jarvis calls minimal viable profits from day one. Instead of burning millions on customer acquisition to fight churn, they focus maniacally on retention and simplicity.
The source mentions the software company 37 Signals, the creators of Basecamp. In their early days, they actually produced a personalized custom video for every single new customer.
That is insane.
Right. From a VC perspective, that is horrifyingly unscalable. It's a massive bottleneck in our causal loop diagram.
It is unscalable, but it's highly profitable in the long run because it builds a fiercely loyal customer base that champions the product through word of mouth. They didn't need a multi-million-dollar marketing budget because the retention was nearly perfect.
Jarvis also details how he engineers his own physical proxies to protect his time. He implements a strict communication system. When he's writing a book, he goes months without outward communication. Mondays and Fridays are entirely communication-free for deep work. He built the copper wire of his system to protect his primary stock, his attention.
The founder of Psychotactics, Sean D'Souza, does the same thing, capping his company's growth specifically so he can take 3 months of vacation every year. They defined their success, built the physical proxy to achieve it, and deliberately stopped growing when they hit it.
So connecting this to you, the listener,
Yeah.
you don't need to build a massive monolithic corporation to operate like an institution. You can be a company of one. But once you map that system and once you cap your growth to keep the hungry ghost out, how do you enforce it?
That's the hard part.
Because it's easy to cap your growth on paper. But when a client waves a massive scope-creeping contract in your face, the temptation to break your own rules is immense.
This is the critical vulnerability of any system, human emotion under pressure. Which brings us to the necessity of formalizing your corporate identity. If you're operating intentionally, you need a binding constitution to govern your physical actions and override your emotional impulses.
And our source on Dex Capitals is the ultimate case study in overriding those impulses. Dex Capitals is a fund management company in Dubai, and their entire identity is based on the explicit, absolute rejection of retail trading and speculative gambling. They operate strictly under what they call a corporate-only fund management model.
It is a fascinating study in institutional discipline. In the retail world, platforms use trading tournaments to gamify the experience. They offer a prize to whoever makes the highest percentage return in a month. It encourages wild leverage, massive risk, and pure gambling.
It encourages the exact gambler's fallacy we talked about earlier, people betting on black to win a leaderboard.
Exactly. Dex Capitals also runs trading tournaments, but they use them purely as an internal evaluation mechanism to recruit talent. And they evaluate them entirely differently. They aren't looking for the trader who makes a 100% return. If you make 100% but you breached a 3% daily drawdown limit to do it, you are disqualified.
Wow.
They are hunting for the trader who makes a steady 12% return while never risking more than 1% of the capital at any given time. They are screening for strict adherence to risk parameters under pressure.
They are hunting for the internal locus of control. But how does an individual replicate that level of cold corporate discipline? I don't have an HR department running tournaments to keep me in check. This brings us to the CFA Institute source and the concept of the investment policy statement, or the IPS.
The IPS is arguably the most vital piece of architecture any investor or business owner can construct. The CFA Institute defines it as a strategic guide that provides an objective course of action during market disruptions. You called it a corporate constitution, and that is exactly what it is.
I really want to explore the psychology of this. Because if I'm just managing my own IRA or running my solo consulting business, writing a formal 10-page legal-sounding document to myself feels ridiculous. It feels like bureaucratic cosplay.
It feels like cosplay on a sunny Tuesday when the market is up and your clients are happy. But the IPS isn't written for the sunny days. It is written for the day the market crashes 35% in a week, the media is screaming about the next Great Depression, and your cortisol levels are through the roof.
Panic days.
Right. In those moments of profound crisis, your prefrontal cortex, the logical part of your brain, essentially shuts down. Fear takes over.
And the retail hobbyist panic sells everything at the absolute bottom, locking in their losses. A classic user error.
Precisely. The IPS is the architecture of extreme ownership because it pre-decides your actions in a rational, cold state so that in an emotional, panicked state, you don't have to think. You just execute the copper wire you already laid down.
Okay, let's unpack the mechanics of a legitimate IPS as defined by the CFA Institute. What actually goes into this constitution?
There are 4 mandatory components. The first is governance. Who makes the decisions? Who executes them? Who monitors the results?
Wait, I mean, if I'm a company of one, I'm literally the CEO, the execution staff, and the janitor, right? How do I govern myself? It feels a bit schizophrenic.
Well, you do it by explicitly demarcating those roles in your schedule. Your IPS might state, strategic asset allocation decisions are only made on the first Sunday of the quarter during a designated board meeting review. During the week, I act only as staff, executing the trades. Staff is not authorized to alter strategy. You build a firewall between your strategic brain and your execution brain.
That is brilliant. It prevents you from tweaking the system daily based on a whim. What is the second component?
Return and risk objectives. But these cannot be vague aspirations like, I want to beat the market. The source gives an example of institutional specificity, targeting a 5% annualized return after inflation on a rolling 12-quarter basis. And equally important, defining your risk budget. What is the maximum quantifiable drawdown you are financially and psychologically prepared to endure before liquidating a position?
You decide exactly how much pain you are willing to take before you ever feel the pain. Third component.
Constraints. This is the perimeter fence of your system. What are your liquidity needs? What is your time horizon? Are there tax implications that restrict trading frequency? Are there ESG, environmental, social, and governance factors? For example, your IPS might explicitly state, under no circumstances will leverage or margin be used regardless of perceived opportunity.
And the final component, which I think is where the true psychological agony happens, rebalancing.
Yes, rebalancing protocols. The IPS must contain strict, emotionless, mathematical rules for returning your portfolio or your business focus to its target allocations.
Let's really drill down into the friction of this, because this is what separates the institution from the hobbyist. Let's say my IPS mandates a portfolio of 60% equities and 40% bonds. We go on a massive, multi-year bull run. Tech stocks explode. Suddenly, because my stocks have grown so much, my portfolio is now 75% equities and 25% bonds.
Great problem to have, right?
I am making money hand over fist. The media says tech will never go down. My friends are getting rich. And my IPS tells me I have to rebalance.
Which means you must actively sell off a massive chunk of your biggest winners, the assets making you rich, and use that cash to buy more of the boring, underperforming bonds just to get back to the 60-40 ratio.
The psychological pain of doing that is immense. Pressing the sell button on NVIDIA when it's up 150% just because a piece of paper I wrote 3 years ago tells me my equity allocation is 15% too high, feels wrong. It feels like leaving money on the table.
It is excruciating. And that friction is exactly why you need the document, because the math of rebalancing forces you to systematically buy low and sell high without having to predict the market. It forces you to take profits off the table during a mania, and it forces you to buy distressed assets during a panic. It is a mechanical override of human greed and human fear.
Writing an IPS forces you to treat your own capital with the cold fiduciary duty of an endowment manager. But here is the ultimate catch-22 of this entire deep dive. You can have an internal locus of control. You can map out a flawless system dynamics workflow. You can draft a bulletproof corporate constitution. And none of it matters if the data you feed into that system is toxic.
That is the fatal flaw in the architecture. A perfectly engineered processing engine will still output catastrophic results if it is fed garbage inputs.
Which brings us to our final frontier, the information diet and how curating your inputs is your ultimate asymmetric competitive edge. To execute your IPS, you must ruthlessly regulate what you allow into your brain. We have a phenomenal source from Scriptbox that uses a dietary analogy to explain this.
It's an incredibly precise metaphor. A dietitian will tell you that physical health requires distinguishing between good calories, lean proteins, complex carbohydrates, and bad calories, refined sugars, trans fats. An institutional practitioner must apply that exact same discernment to data.
Let's categorize this data because Scriptbox breaks it down into 5 distinct types of information. What are we actually consuming?
First, there is useful but expiring information. This is data that is highly relevant today but worthless tomorrow. A company's quarterly earnings report or a sudden change in interest rates. You need it to execute, but it has no shelf life. Second is useful and permanent information.
This is the foundational bedrock. Understanding the mathematical mechanics of risk management, learning how to build a causal loop diagram, understanding the psychology of extreme ownership, this knowledge compounds over decades.
Exactly. Then we get to the third category, which is the most deceptive. Useful, but wrongly showcased.
Let's debate this one because it's tricky. How do you identify this?
This is data that is factually accurate, but maliciously framed. Imagine a venture capitalist hyping up a specific sector, presenting perfectly true growth metrics, but they are showcasing it specifically to pump their own bags and create exit liquidity for themselves, conveniently ignoring the systemic macroeconomic risks. It's a true statistic wrapped in a toxic narrative.
Okay, the fourth category is information that requires immediate action. This is crucial binary data that often gets buried. A regulatory change that makes your product illegal, or a critical vulnerability in your software.
And finally, the fifth category, the absolute worst of the bad calories, which consumes 99% of the retail hobbyist's attention. Useless but entertaining.
The noise, the rumors, the panic-inducing clickbait headlines, the endless scrolling of finfluencer hot takes. Let's look at some of the toxic junk food habits investors fall into. Obsessing over a tiny 0.05% expense ratio increase and panic selling. Trying to day trade the daily news cycle, which the source notes is a literal recipe for a heart attack, and the most common one, staring at your portfolio app every hour, watching the red and green numbers flash.
That constant checking is devastating because it forces a short-term emotional reaction, which completely violates the long-term constraints of the IPS you just wrote. You are feeding your brain high-fructose corn syrup and expecting it to run a marathon.
I want to apply this information diet to arguably the most chaotic, noisy, junk food-filled environment on the planet, the crypto trading space. We have a source breaking down a tool called gmgn.ai, which tracks Solana wallets. This is the perfect crucible to show the difference between a retail hobbyist and an institutional pro.
The crypto space is the ultimate test of the internal locus of control. The retail hobbyist approach here is entirely driven by bad calories. They log on to social media, find highly followed KOLs, key opinion leaders, and they blindly set up bots to copy trade those KOLs' wallets.
And they almost inevitably get slaughtered. Why? Let's
Yeah.
unpack the mechanics of why copy trading fails.
It fails because the information is mathematically too crowded by the time it reaches the retail layer. By the time a KOL tweets about a token or their massive wallet move triggers a public copy bot alert, the price has already spiked. The hobbyist buys in at the top, suffering massive slippage, while the KOL is already selling their position into that surge of retail volume.
So they're just getting dumped on.
Yes, the hobbyist becomes the exit liquidity. They are executing physical actions based on useless, entertaining hype.
They are trusting external gatekeepers instead of building their own system. So how does the institutional practitioner, the pro, use a tool like gmgn.ai? because they don't ignore the tool. They just filter the data completely differently.
The professional uses the platform strictly for manual token investigation. They aren't outsourcing their execution to a copybot. They are conducting deep, granular, forensic research. The source details the exact metrics OPRO dissects. They don't just look at a wallet's total win rate or total profit because those numbers can be skewed by one lucky trade. They look at the spread between unrealized versus realized profit.
Which tells you if the trader actually has the discipline to lock in gains and manage risk, or if they're just holding a volatile bag of paper wealth that could evaporate overnight.
Exactly. They examine holding duration. Is this wallet making calculated long-term thesis plays, or are they frantically scalping micro-profits? They analyze the 30-day transaction ratio of buys to sells to gauge accumulation versus distribution. They are digging into the specific entry and exit prices down to the decimal.
It's an information autopsy. They are surgically breaking down the mechanics of the market. And here is the real institutional flex from the source.
Yeah.
It explicitly warns that GMGN.AI's aggregate statistics are sometimes inaccurate due to how blockchain data is indexed. So what does the pro do?
They never rely on a single source of truth. The professional takes the raw wallet address from GMGN.AI and manually plugs it into an entirely different analytics platform like CLO Finance to cross-reference and verify the numbers. They know data aggregators have flaws. They triangulate the truth.
Your results will only ever be as good as your inputs. By filtering out the KOLs, rejecting the junk food narratives, and doing the grueling manual research to verify the raw data, you maintain your competitive edge. You build a firewall around your mind.
It is the ultimate manifestation of everything we have discussed. You aren't relying on an external influencer to make you rich. You are relying on your own verified data processed through your own structurally mapped causal loop diagram and governed by your own emotionless investment policy statement.
Wow. Okay, let's step back and look at the massive blueprint we've just constructed. We started by looking inward, adopting an internal locus of control, and taking extreme ownership of our outcomes by conducting honest, brutal error autopsies. We stopped blaming systemic forces for our own user errors.
From there, we architected our intentionality. We learned how to map our systems dynamically, translating mental desires into physical proxies using that gym analogy. And we adopted the company of one philosophy, intentionally capping our growth to prioritize minimal viable profits over the hungry ghost of VC-fueled scale.
Then, we formalized our identity. We studied the cold discipline of DEX capitals and learned how to draft our own investment policy statement, forcing ourselves to mechanically rebalance and act like an institution, even when our emotions are screaming at us to panic. And finally, we safeguarded that entire processing engine by implementing a ruthless information diet, filtering out the noise and triangulating the truth.
It is a comprehensive end-to-end framework for professional execution. But I want to leave you with one final thought to mull over, something that takes this entire architecture and points it at a completely different target. We have spent this deep dive applying the concept of an investment policy statement, a strict written corporate constitution, to your business workflows and your financial portfolios. But what if you drafted an IPS for your personal relationships or your physical health?
Oh man, that is a profound shift in perspective.
Think about the mechanics of it. If you had a physical written document detailing your personal risk constraints regarding your health, or establishing strict rebalancing protocols for when you spend 80 hours a week at work and neglect your family, how would that change your life? If you defined your acceptable daily inputs for your marriage the same way you define them for your crypto portfolio, would you survive the audit? The question is, are you acting like a highly disciplined institutional practitioner in your business, but remaining a reactive, dart-throwing retail hobbyist in the most important areas of your life?
That is the ultimate question you have to ask yourself. Are you going to keep standing in the dark, hoping luck bails you out, or are you going to take extreme ownership, build the copper wire of your system, and take control? We want to warmly thank you for joining us on this deep dive. Stay curious, stay incredibly disciplined, and keep learning.